Hello and welcome to this edition of Money in Motion video blog. This is Dan Perkins, and thanks for watching. Well, the first 5 weeks have been a real roller coaster. Up and down, crude oil from 27 to 35, stock market all over the place, economy slowing down in the fourth quarter to only up 0.75%. Yet, last Friday we had the jobs number of 155,000 new jobs, and the unemployment rate went down to 4.9%. What was very little reported was the fact that there was an uptick in the people who are not working, people out of work, looking for work, or doing part-time work, looking for full-time work. That's the index that is used to measure the number of people not really participating in the economy. There are two other factors. The employment participation rate, that's a measure of how many people or a percentage of people are working that can work. And the second number is the number of people who are out of work, who have given up looking for work. So the first number, the higher the number, in this case close to 63, says that only about 37% of the people who could be working are working, the rest are looking for work. So the employee participation rate is about 63%. In addition, the number of people out of work who've exhausted, for example, all of their Social Security benefits or their unemployment benefits or long-term unemployment benefits and are now looking at going on to disability, that number is close to 94 million people. 94 million people in this country. So when we see that we have 155,000 jobs created and we see an unemployment rate of 4.9, these are really bad numbers. So you may be asking, why am I focusing on these two numbers? Well, two things that the Federal Reserve is charged with the responsibility to try and manage. One is the inflation rate, and two is the employment, jobs. The unemployment rate at 4.9 would say that the economy is reaching full employment, except we've got tens of millions of people unemployed. And on top of that, the participation rate is very low. So that the real unemployment rate is probably close to almost 10% in an article I saw on Friday. So the Fed has to be really concerned about employment, the number of jobs that are being created, the number of people working. And number two, inflation. Well, inflation is going nowhere. In fact, I expect that we're headed for a period of deflation as energy prices settle in and begin to work their way through the economy at $30 to $35 a barrel. So you may be asking yourself, so why is this important to me? It's important to you because the Federal Reserve is the organization that sets interest rate policy in the United States by controlling the discount rate and the Fed funds rate. Now, Janet Yellen and the Fed raised rates 0.25% in December, and all you have to do is look at what happened to the markets after they raised the rates 0.25 point. At that particular time, they were looking to raise rates 4 more times in 2016. I understand that they need to be able to put more bullets in their gun. Every 0.25 point increase in interest rates puts a bullet in their gun, so if the economy falters, they can at least begin to lower. But I think they were caught off guard by the fact that the Japanese government announced a week or so ago that they were adopting, much like Central Europe and the Euro, a negative interest rate policy. What does that mean? That means if you want to buy a piece of government bonds out to, say, 5-year maturity in either the EU or in Japan, you now are going to get no return. In fact, you're going to have to pay the government between 1/10 and 0.5% in order to buy those bonds. Now, in the January announcement of the stress test for the American banking sector, the Federal Reserve said they want the banks to stress test for negative interest rates of between 10 and 50 basis points. That's 1/10 of 1% to 0.5 of 1%, and that for a period until 2019. So clearly, because the Fed is putting it in the stress test, it's something that they're going to consider. And with only 125 basis points should the economy falter, they can take the 25 back, but it's going to be a difficult time for them the rest of the way to figure out what to do. So I suspect that negative interest rates are also on the horizon for the United States. What does that mean to you? That means if you want to put money in a bank, you're going to have to pay the bank to take your money. Yeah, you heard that right. You're going to have to pay the bank to take your money. If you want to buy a short-term treasury obligation, you're going to have to pay the government to take your money. And oh, by the way, if you've had money in a money market mutual fund for the last 8 years where you have earned nothing on that, expect that if the Fed adopts this negative interest rate policy, that you're either going to have a decline in the value of your capital, or the money market fund is going to begin to assess you a fee to pay for the discount that they're going to have to spend in order to buy paper for your account. So that's on the horizon. Why is all this happening? Because the whole world has slowed down to a level that the central banks are running out of things to do to stimulate the economies, whether it's to hire people, to build new businesses, whatever. We have a very tepid economy. We have probably one of the better economies in the world, but we grew by 0.75% annualized in the fourth quarter of last year. And the way things are starting off this year, I would expect to see that the growth in the GDP is going to slow even more. So these are slow times. It's going to be extremely volatile times. And I think it's important to talk about these issues because while they may not be on your horizon today, they're on mine and I'm thinking about them. You need to think about them because when you begin to hear about them, you'll remember that you heard them here first. How does that affect us? In a negative interest rate environment, anything that pays a positive return will be more valuable, more desirable. So preferred stocks, common stocks that pay dividends, REITs, master limited partnerships, anything that produce cash flow are going to be extremely desirable assets. Because with a slowing and no growth economy, it's going to be hard for corporations to grow their business, both domestically and foreign. So income investments, which we own a lot of, will become much more desirable over time. Now, let's turn to oil. The president this week decided he wants to propose that there should be a $10 surcharge on every barrel of oil pumped in the United States as a tax, a 33% tax based on what's going on today in the oil markets, and use that money to fund green energy organizations. This administration and most administrations have very difficult times in picking winners. We all know about the Solyndra in the solar panels that lost the government over $500 million. I think it's a very bad idea. It's going to make American energy more expensive by $10 a barrel and unable to compete in the world markets and create an opportunity for the Middle East, the cartel known as OPEC, to come into the United States and flood the U.S. market at a price advantage to take market share and to put more and more pressure on the oil companies. I think the idea is a good idea. He's just applying it to the wrong people. I think that we should take $10 and apply it to every barrel of oil we import from an OPEC nation or a nation that is sympathetic to OPEC, and let's use that money to fund alternatives, but let America have a free market so that we can compete on an open market, and with the $10 a barrel advantage, we can begin to take market share away from OPEC. Now, there's one more thing that I want to talk about as it relates to oil. You've heard me on this blog and on my various other blogs, thehill.com and etc., that I believe that we're in a situation where energy prices are going to stay low. And as a result, the revenues necessary to the OPEC nations is declining, that revenue necessary to fund their budgets. But there's another problem. If you don't have the money to fund your budget, where do you get the money to pay for the repairs to your refineries and pipelines? I think with Russia having a $50 billion deficit. Saudi Arabia had a $150 billion deficit last year and probably is looking at one equally as large. In fact, the International Monetary Fund said if this continues in the $30 to $40 range, Russia will be bankrupt as a nation in 18 months, and Saudi Arabia, yes, Saudi Arabia will bankrupt another 18 months beyond them. So they're not going to spend the money to maintain, which means they're going to have accidents, they're going to have spills, and they're going to start cutting production because they can't run their facilities. This will take some of the oil out of the marketplace. We have a surplus of about 2 million barrels a day. And how soon we can eat that up, it will depend on how much the economies around the world grow. I do believe that if we have a change in administration in November, we will see an opportunity to grow this economy and lead the world as being the greatest growth economy. So I'm looking for things to happen positively. I do want to close by saying it's going to be a bumpy ride, as it's been already. And people who are watching their portfolios every day get very, very nervous because they go up and down in such wide swings. I watch them every day because it's my job to watch them every day. You don't need to watch them every day. Looking at your statement once a month is more than enough time. I really believe that we are in a cycle where the first half of this year is going to be very difficult. The third quarter is going to be kind of neutral. And I think the fourth quarter, October, November, December, could see a very nice rally in the American markets and in our portfolios. So be patient. Don't get overly concerned. You're getting your dividends, you're getting your monthly payments, you're paying your bills. That's what it's for. That's what we're trying to do. So if you have any questions, please feel free to give me a call or send me an email. This is Dan Perkins, and thanks so much for watching.